What's up, everybody? It is Sheen Trades. I haven't done a video like this in a while, but I know I said that I was going to make a video on how to sell options within the market. So, one thing to take note of is that I have been doing this for the better part of a year and a half. For those who don't know, I started trading back in 2018. We are in 2025 now, so I've been doing it about 7 years. For those who don't know, I have a relatively large portfolio that I run this strategy on. The main important factor here is that you need some form of capital in order to do this and make pretty solid money. I think bare minimum you should be starting out with when doing this is about 30 to 45K or 30 to 50K. Um, and the reason I suggest this is because I think it's overall the safest way to make money in the market, as well as the best way to quote unquote guarantee the money that you're making in the market. So, my large portfolio is currently sitting around 1.75 mil. We're at 1748, 1.748. But this is pretty much it right now. You can tell it is a live account right there, and whatnot. But yeah, so the portfolio that I'm using on this one, this is a smaller one that I had started. We're sitting at around 39.8 right now as of today, as you can see. Some positions that I have open on this account is CoreWeave, INTC, and QUBT. So this account started with 35,000. Let me unhide this. Yeah, so it's up about 4,500, almost 5,000 now. So for those who have been following me on Twitter, this is an account that I put together so that I can show people that you can do it with around 35, anywhere from 30 to 50. I think it's very, very possible and whatnot. So I wanted to show people exactly, I guess, some formal details about selling options. So when you sell a put, how it works is you need at least $100. You need at least enough capital to purchase 100 shares at whatever strike price you sold it at. So, for example, this QUBT 18 put, right? So I need at least $100 per contract, or 100 shares. And I need at least, sorry, I'm getting my words mixed up. I need at least enough cash to purchase 100 shares. So at the strike price. So if I pick the 18 put, 18 times 100, I need at least $1,800 per contract. And as you can tell, the trade price here is 200 or 2.42 or $242. So how it works is, instead of buying it as everybody typically does as a day trader, you sell the option and then you take credit for the cash. So since it was sold at 2.42, I immediately gained $242 in cash for every contract that I sold. So I sold 4 of these, and once again, it was $1,800 in collateralized cash, meaning 1,800 times 4, I needed $7,200, as you can see the buying power and effect right here, in order to make 242 times 4, so $968 for $7,200, and this is for November. So once again, I usually like to shoot for 7 to 8% every month on the safer side of things. If I can get more, around 10 to 15, great. CoreWeave, for example, back then I was running these on CoreWeave. The max I had gotten was like $3,200 for one contract, and it was for, I believe, 3 months out. It was like 91 days or something like that. So in 3 months, I basically net 30% return on the cash that I put, which is pretty solid. So, yes, this is slow. Yes, it's not glorious in terms of like your day trading and whatnot. So one thing I like to show people is that if you're a day trader, you can easily do this so long as you have the capital, right? And why I say that is because a lot of it is still technical analysis. So let's take, recently I sold INTC, as you can tell on this account. So the reason why I sold INTC is right here. Literally something super, super simple as, retesting a previous resistance, seeing that it turned support, right? So I sold contracts on this day, on Tuesday, when we hit this area at the low. And next day, there was some news that happened. Great, we bounced right off of it. Perfect. That's exactly what we'd like to see. So the main goal of selling options is so that you take advantage of theta. And when I say take advantage of theta, I mean specifically you want these contracts to go to zero, right? Because instead of buying and then selling, right? If you buy an option, you expect the value of the options contract to go up and then you can sell it for profit later. No, this is the complete opposite. You want to sell the contract and you want it to go to zero so that you can buy it back later for way cheaper or let it expire zero and collect the full credit. So I hope that kind of makes sense. And let's say, for example, since I sold the 33 put right on INTC here, as you guys can tell, for December 19th, let's say by December 19th or the expiration date, INTC is, below the strike price that we had sold the 33 mark. What happens is I am forced to purchase 100 shares of INTC at the strike price that I had selected at the expiration date. It's very low odds that you get exercised. Let's say, you're down or you're in the money. It's very low odds that you get exercised before expiration when the contracts are in the money. And with that being said, there's a lot of ways to calculate break even. So let's take INTC, for example, just because I have the chart here. I have the trade price, right? So I sold these for $319 or 3.19 at the 33 strike. So how you calculate your break even per se if you were to get assigned on shares, right? I'm actually going to use this here because it's easier. INTC. I can put a chat box here. So 33 strike at 3.19. So how you calculate your break even is you literally take your strike price minus the price that you sold it at. 31.19 equals 33 minus 3.19, $28.81 per share. So remember, you are forced to buy 100 shares of these at 33. So let's say by expiration, INTC is sitting at, $32. So technically, you're still break even. You're in the profit zone, right? Like this is break even. So you're in the profit zone. Why? Because your break even is this. You maximize your credit here, and INTC is sitting at $32, right? So if you want to calculate how much you're up, you do 32 minus 29.81. And you're still up a solid $219 per every contract that you sold or per 100 shares, right? Per 100 shares, right? So the reason why this is super important is because now you can calculate where you can sell your calls because you're going to be forced to buy 100 shares. So now you go do the opposite and then you sell calls on it to collect even more credit. And when you sell a call, instead of leveraging the capital required to purchase 100 shares, you leverage your 100 shares and vice versa. Let's say once again, now you're here, you sold the 35 strike when the stock is sitting at 32 at, let's say, 3.0, we'll make it simple numbers, right? So now you can maximize again and find out your break even. So you do 29.81 minus the 3.0, which is the credit that you sold it at. And then you get 26.81, right? So this is now your break even. And this is sort of how you can tell how much profit you're in because, your trading view or your broker, for example, Charles Schwab here, isn't going to tell you your break even on the stock. So let's say now, INTC at expiration of this call, INTC is sitting at 36. So what happens here is that you're forced to sell your shares at $35. You're just forced to sell all the 100 shares for, however many, for the one contract that you sold. So for this example, we'll just stick with one contract because it's easier. I hope this is making sense. It does take a little bit of time to understand and get used to. But the profit that you make now, right, let's calculate. So you sold, profit calculator. You sold the 33 call or 33 put for $319. You sold 35 call for $300. And then since you're forced to sell out of your shares on the share side, you make $2 per share, right? Why? Because you were forced to buy it at 33 and now you're forced to sell it at 35. So you make $2 per share. And in this instance, once again, we're using one singular contract. So you were forced to purchase 100 shares. So you make a profit of $200 on the share side. And your total net is going to be 300 plus 200 plus 319, and you get 819, I believe. Let me double check that. 300 plus 319 plus 200. Yeah, so you make $819 in total profit on this position, leveraging your cash as well as leveraging your shares that you were assigned. So this is the very like basic breakdown, and it takes time, right? You're not, bear in mind these contracts are 3 weeks out, 2 months out, 3 months out, even sometimes. That's usually the maximum I'll go is 3 months, so 90 days, give or take, plus minus 5 on each side. But yeah, for those who have always been asking me to make a video, this is sort of that video. And like I said, if you're a day trader, it's very easy to depict whether or not you want to get in on a position, right? Like I said, something as simple as retesting support and resistance here is your way to entry, right? Because if you're selling a put, you want the stock to go up so you don't get assigned and you just make maximum credit. And if you're selling a call, it's vice versa, right? So you have to think of it in the complete opposite way of like, okay, instead of longing calls at previous resistance turn support, the next thing you do is you basically sell a put and you capitalize on the fact that you are playing with theta instead of playing against it, and you don't need the stock to go up in order to make the money because you make it right away because it's credited to your account as cash. So that's my short spiel on it. So anytime you sell options, you have to think about it in the opposite way. So usually, let's say, like I said, if you want to go calls here, great. You can definitely go swing trade some calls. But if you want to guarantee your money, you can sell puts, right? You can sell a put, collect the credit. Yes, you cap and you put a ceiling on how much profit you can make. However, it's safe. You're guaranteed the money no matter what at the end of the day. And that's sort of why I like doing this, because with a large enough portfolio, currently sitting at 1.7, I can easily rake in, comfortably and safely 50K a month without getting exercise on anything. And that's my main thing as to why I think and believe that people with large ports should be doing this, is because you can guarantee money. Yes, you're not taking advantage of crazy moves or crazy gains, however, but this is comfortable. This is guaranteed. And usually, how I like to tell people that I show how to do this is essentially I tell them use 80% of your cash, put it into blue chips or your main uh, stocks that are stable. You can comfortably make 7%, to 8% every 2 to 3 weeks on those, on however much cash you put into it. Um, so you can make 7 to 8% on your 80%. And then for your last 20% of cash, you can go into stocks like your growth stocks or your potential stocks. So for example, right, I have QUBT, INTC, CoreWeave. These are stocks that have recently gained a lot of traction because of their name, and that's completely fine, right? Because it only takes up 20%, and usually you can hit 10 to 15%. Occasionally, you'll see something like CoreWeave when it's absolutely going bananas, and you can do 30% in 3 months. Um, but yeah, so and that kind of adds up, right? Because if you do 7% every 2 to 3 weeks, you can get to, or even a month, you can get to 20% return on your cash. So hopefully this video helped. It's super short. It's super to the point. But this strategy, for those who don't know, is called the wheel strategy. There's tons of YouTube videos on it. I'm not reinventing the system or creating my own strategy. No, I'm using something that has been proven to work and people do it all the time. And I'm utilizing options for the exact purpose of why they were made. Options were created to hedge. They weren't the main source of options, or the main reason of options was to hedge. It wasn't to be like, oh, I'm gonna go ODTE fucking 50 grand worth of options and it's gonna 300%. That was never the main goal of options. But anyways, I hope you guys enjoyed this video. I hope it made sense. If you have any questions, feel free to DM me on Twitter. That's where I'm most active. And yeah, if you guys have any questions, thank you.